Hello friends, I am Ganesh Kamath and welcome to Simply Speaking. Investors are always on a hunt for finding the right asset class, right timing and the right asset mix to invest. However, this proves to be a tiring exercise. Hybrid funds, in a way, provide an effective solution for achieving this balance. Hybrid funds allow investors to benefit from the expertise and experience of fund managers while avoiding the complexities of individual stock selection and portfolio rebalancing. Different types of hybrid funds cater to different types of investor preferences and risk profiles. For those seeking more growth-oriented strategies, aggressive hybrid funds with a higher allocation to equities may be suitable. On the other hand, investors with more conservative risk appetite can opt for hybrid funds which predominantly invest in fixed income securities or arbitrage. Investors can also look at multi-asset allocation funds which invest in multiple asset classes like equity, fixed income and gold. How do we find the right balance in our portfolio? It is through asset allocation. What should be your asset allocation will be based on your current financial situation, your risk appetite, investment goals, and market conditions. At SBI Mutual Fund, we use our in-house asset allocation framework that guides our fund managers to take an active stance on asset allocation across market cycles. This framework comprises of three broad parameters: valuation, sentiments, and earnings that helps them to quantify the outcome of the asset allocation framework. In this video, let us take a brief yet a closer look at these three pillars. When we talk about valuations, we are trying to answer the question, how much is something worth? Valuations in simple terms refer to the process of determining the worth or value of something. In our asset allocation framework, valuations refer to knowing the value of an asset in relation to another. This framework analyzes various metrics to determine whether a particular asset is overvalued, undervalued, or fairly valued. To do this, we evaluate earnings yield to determine the current valuation of equity markets vis-a-vis bonds. Earnings yield of equities is arrived by dividing the earnings per share of the Sensex by its price. Bond yield, on the other hand, refers to the income generated by the bond relative to its current market price. Therefore, in this framework, we aim to track the spreads between earnings yield of equities and yield of 10-year G-Sec to determine how expensive equities are in relation to the risk-free asset. So, what do the spreads between earnings yield to bond yield tell us? As you can see in this graph, when equity earnings yield to bond yield spread is relatively higher than its historical average, it suggests that equities may be relatively more attractive than bonds. On the other hand, when the spread is below the historical average, it suggests that equities are in an expensive zone and in general considered overvalued. Another way to look at it is that the bond yield is normally used as a risk-free rate when calculating the cost of capital. When bond yield goes up, then the cost of capital goes up. This means that future cash flows from equity investments are discounted at a higher rate. The higher discount rate leads to low valuations for equities and vice versa. When we arrive at a Sensex trailing earnings yield at 4.24% and subtract 10-year bond yield at 6.99%, the result is negative 2.75%, which, as you can see in the graph, is lower than the long-term average of negative 2.18%, indicating equities to be moderately expensive. Likewise, we also use another metric in the valuations model, which is Shiller earnings yield. The Shiller earnings yield is arrived at after adjusting for earnings cyclicality and inflation typically of last 10 years. This helps smooth out short-term fluctuations in earnings caused by business cycles and unforeseen events like COVID, 2008 crisis, and so on. The final valuation score in the asset allocation framework helps us in identifying opportunities by considering whether assets are overvalued or undervalued. Warren Buffett once said, "Be fearful when others are greedy and be greedy when others are fearful." This, as we know, reflects the investor sentiments, the next variable in our asset allocation framework. We have developed an in-house proprietary framework called as ESI, Equity Sentiment Index, by combining over a dozen sub-factors broadly categorized such as market internals, positioning, trailing returns, FII and DII activity, Google search trends, and so on. These sub-factors are designed to quantify the market sentiment and then examine whether there is some predictability of returns from the aggregate of these variables. While we analyze the relationship between ESI and Nifty returns, we can see that when the ESI is in the zone of hope, it suggests increased optimism in the market sentiments. It usually is associated with subdued one-year forward returns on the Nifty, signaling lower allocation to equities. Whereas when the ESI is in the zone of worry, it suggests high pessimism in the market sentiments. This is associated with strong prospective returns on the Nifty, signaling relatively higher allocation to equities. The Equity Sentiment Index thus is an indicator for investor sentiment and helps identify whether the sentiment is in the zone of fear or greed. It is essentially a contrarian indicator. That is, when sentiment is pessimistic, that usually implies good entry points, and when sentiment is euphoric, that is the time to be cautious. It is not the market that drives the value of the stocks, but the expectations of earning from the business in the long run that makes it valuable. Macro factors, including fiscal policy, monetary policy, and credit market conditions, can have significant impact on the earnings of businesses. We look at variables like money supply growth, shape of the yield curve, credit spreads, and so on, and the likely impact of various macro factors on these variables that can eventually influence market returns and thus help us to make a well-informed decision. Asset allocation framework is a powerful tool that helps our fund managers to quantify impact and sensitivity of each variables on asset classes across market cycles and serves as a guide in deciding the optimum allocation to equities. We review this in-house framework on a periodical basis and at times much frequently if we experience major or unusual swings in the equity markets. Allocation to equities can vary between 0 to 100% depending upon the interplay between valuations, sentiments, and earnings. When the collective reading of these parameters are positive, then the model might suggest an increased allocation to equities up to 100%, and if it is negative, it may indicate reducing our equity exposure to even 0. In a scenario where all three parameters are neutral, then allocation to equity and debt will be in the ratio of 60 to 40. In case, even if one parameter is negative, equity allocation can go down to 40. Whereas, if two parameters are negative, equity allocation can go down to even 20. This way, investors looking for a convenience and robust framework in striking the balance across asset classes can look at hybrid funds from SBI Mutual Fund. The inherent flexibility of these funds can offer you a one-stop solution to all your asset allocation needs. We hope you found this video informative. Remember, it's always important to consult your financial advisor to understand your asset allocation requirements. Stay tuned for more informative content and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.